What if the biggest financial burden on an entire generation didn't start as a crisis? What if it began as a well-meaning policy, tucked inside an obscure law, designed to help students from low-income families go to college? And what if that small, quiet program morphed, over just a few decades, into a $1.7 trillion debt machine? Right now, over 43 million Americans owe money for attending college. That's more than the population of California. For many, this debt follows them into marriage, home ownership, and even retirement. But here's the thing. This mountain of student debt didn't just happen. It was created, piece by piece, law by law, lender by lender. So how exactly did we get here? And perhaps more importantly, who profited from it? To understand that, we have to go back. Not just a few years, but all the way to the 1940s. In the aftermath of World War II, the United States was transforming. The GI Bill, formerly known as the Servicemen OS Readjustment Act of 1944, offered returning soldiers access to college tuition and low-interest home loans. It was revolutionary, and it worked. College attendance skyrocketed. But most Americans weren't soldiers, and they didn't have that kind of access. As the baby boom began, and more families aspired to send their children to college, the question of cost began to rise. In 1965, under President Lyndon B. Johnson, the Higher Education Act was signed into law. Its goal was noble: increase access to higher education for low and middle-income students. One part of this law, relatively minor at the time, introduced government-backed student loans. These weren't grants. They were loans students would repay, but with the government covering defaults, it seemed like a safe bet. What lawmakers didn't foresee, or perhaps chose not to consider, was the scale. In the early years, student loans were manageable. College was cheap. Public universities charged a few $100s per semester. A part-time job could cover books, rent, and tuition. There was no ecosystem of predatory lending, no multi-billion-dollar loan servicing industry. But something began to shift in the 1980s. As more students took loans, colleges realized they could raise tuition. Demand was high, and loans made it easier for students to pay. In other words, the introduction of easy credit artificially inflated the price of college. And once prices went up, they rarely came down. By the 1990s, the situation was beginning to look familiar. Tuition had risen steadily for decades. Private lenders had entered the market, encouraged by government guarantees. Politicians, Democrats and Republicans alike, saw student lending as a win-win. More Americans in college, no immediate hit to the federal budget, and a growing education sector. But while the public narrative was one of empowerment, behind the scenes a dangerous loop was forming. Colleges raised prices, students borrowed more, lenders got rich off interest. The government guaranteed the loans, and default rates quietly began to rise. In 1992, a critical turning point occurred. Congress removed the cap on how much students could borrow in federal loans. Suddenly, graduate students could borrow nearly unlimited amounts, and colleges, especially for-profit institutions, seized the opportunity. They advertised aggressively, promised high-paying careers, and admitted students en masse. Some schools offered little more than a flashy website and an empty promise. But with loan money flowing, no one seemed to care. By the early 2000s, the numbers were growing alarming. Outstanding student debt passed $300 billion, then $500 billion. Then, following the 2008 financial crisis, it exploded. As the job market collapsed and traditional careers became scarce, millions of Americans went back to school. Degrees were seen as protection against economic instability. But they came at a price. Tuition continued to rise, loan limits expanded, borrowers piled on debt, not for luxury, but survival. For some it worked, but for many it didn't. Graduates found themselves underemployed, saddled with 5 or even 6 figures of debt, working jobs that didn't require a degree. Default rates spiked. Loan servicers, private companies contracted to manage federal loans, were accused of deceptive practices. They steered borrowers away from forgiveness programs, misinformed them about repayment options, and profited from confusion. One infamous case involved Navient, a major loan servicer. In 2022, it settled with 39 states for $1.85 billion Over allegations, it pushed borrowers into costly forbearance instead of helping them enroll in income-based repayment plans. But by then, the damage had been done, and still, the debt kept growing. By 2010, student debt surpassed credit card debt. In 2014, it passed $1 trillion. Today, it stands at over $1.7 trillion, and that's more than the GDP of Australia. But numbers alone don't tell the full story. Behind that $1.7 trillion are millions of lives reshaped. People who delayed marriage, children, and home ownership. People whose wages were garnished, whose tax refunds were seized, whose social security checks were reduced decades later because of loans they took as teenagers. And perhaps most disturbing of all, the debt can't be escaped through bankruptcy. Thanks to laws passed in the 1990s and 2000s, student debt is one of the only types of consumer debt that follows borrowers for life, unless it's repaid or forgiven. Which raises the question, what about forgiveness? Several programs have promised relief, including the Public Service Loan Forgiveness, PSLF program. Created in 2007, it offered forgiveness after 10 years of on-time payments while working in qualifying public sector jobs. But the system was so complex and the rules so poorly communicated that by 2017, 10 years after its launch, less than 1% of applicants were approved. This wasn't just bureaucracy, it was systemic failure. Fixes were proposed. The Obama administration attempted to streamline income-based repayment and crack down on for-profit colleges. The Trump administration rolled back some regulations, citing government overreach. The Biden administration introduced large-scale forgiveness proposals, some of which were struck down in court, while others, like the SAVE plan, are still rolling out. But none of these fixes have addressed the core issue. Why is college so expensive in the first place? The answer, in part, lies in the distorted market student loans helped create. Unlike normal markets, where prices are restrained by what people can pay, the student loan system guarantees payment upfront, regardless of outcome. Colleges face little incentive to lower costs or prove value. Degrees became products, students, customers, and loans? Just a lubricant to keep the machine moving. Today, for-profit colleges remain a significant part of the landscape, despite scandals, closures, and federal investigations. Meanwhile, public universities have increasingly turned to out-of-state and international students who can pay higher rates. And private universities? Some charge over $80,000 a year. But what do students get in return? For some, a transformative education. For others, a generic diploma and a decade of debt. Outcomes vary wildly by major, institution, and background. Yet the debt is the same. And the impact doesn't stop at individual borrowers. Student debt has become a macroeconomic force. Studies show it suppresses home buying, delays small business formation, and widens the racial wealth gap. Black borrowers, on average, owe more and pay off debt slower than white borrowers. First-generation students often take on more debt but lack the family networks to navigate repayment. This is not just a personal finance issue. It's a systemic one, and the patterns are repeating. Consider this. As tuition rose, student loans expanded. As loans expanded, for-profit colleges grew. As they grew, defaults increased. And yet, even as the failure of the system became clear, it was politically safer to blame borrowers than reform the model. We've seen something similar with housing in 2008, with healthcare costs, with subprime auto loans. Each time the surface problem was different, but the underlying structure was the same. Unchecked lending, misaligned incentives, and a failure to protect the public. So where do we go from here? Some advocate for full-scale cancellation, wiping out all federal student debt. Others push for means-tested relief, tighter regulation of colleges, or even tuition-free public education. But so far, no solution has addressed both ends of the pipe, the loans and the costs. And until we do, we may just be rearranging furniture on a sinking ship. So what should we take away from all this? First, student debt isn't a personal failure. It's the predictable result of policies and systems that place risk on individuals while shielding institutions from consequences. Second, fixing the system requires more than forgiveness. It demands structural reform, transparency in college outcomes, accountability for predatory schools, and perhaps a complete rethinking of how we fund higher education. Third, the burden is not equally shared. Communities of color, low-income students, and first-generation college goers bear the brunt of this system. Any solution must be equitable. But here's the warning. If we don't fix this now, we're setting the stage for the next crisis. Because right now, the machine is still running. Tuition is still rising. Loans are still being issued. And every year, a new wave of 18-year-olds signs on the dotted line, often without understanding the terms, the risks, or the future cost. The question is, do we have the courage to stop the machine? Or will we let another generation fall into the same trap? If this story resonated with you, don't just click away. Share it, discuss it, question the assumptions you've been taught about college, debt, and responsibility. And if you're still in school, or about to be, dig deep into the real cost and the real value of the degree you're pursuing. Because understanding the system is the first step to changing it.